So what is financing? Financing is a process of providing funds for business activities, making purchases, or investing. Its use is crucial for allowing companies to purchase product out of their immediate reach. So in order to choose the right source, you have to ask yourself for financing. How much financing is needed, whether if the borrow loan is for short term, like a year, medium, or long term.
These are some types such as crowdfunding is the use of small amounts of capital from a large number of individuals to finance a new business venture. It is useful for an easy accessibility of vast networks of people through social media and crowdfunding websites to bring investors and entrepreneurs together.
Sales, the selling of a product to sustain the business and maintain a profit. Sponsorships, a variety of providers and entities supporting the goals and objectives of an individual or company. Sponsors can invest in private companies, create demand for publicity, and platforms for benefits, and many more.
To know your budget setting, you will first need to know your expenses, then estimate the cost for the next period, and finally consider the expected changes in rates changes per unit.
So now introducing budget of costs, are basically detailed expenses associated with operating your business, running a project, or developing a product. It is crucial for decision making, such as when to negotiate contracts, expand your business, and control your value. A cost budget can help you identify next expenses for your company. They can be divided, meaning that you can make multiple budgets for several things, like for project cost or developing a project. They are essential for all the significant expenses that your company will face.
Revenue is the income from the sales of goods and services, anything that has capital or assets. It's usually shown as a top item in an income. Profit, a financial gain, especially between the amount earned and the amount spent in buying, operating, or producing something. Total revenue, basis on which tax is computed and dividend is paid.
Break-even analysis is a technique that entails the calculation and examination of the margin of safety for an entity based on the revenues collected. An associated cost is used by production management and management accountants. It is based on categorizing production costs between those which are variable. Break-even analysis in economics refers to the point in which total costs and revenue are the same. Break-even point is used to know how much money you need to make for you to cover all total costs. It's a point of balance, making neither a profit nor a loss. The calculation for break-even analysis. You can use this formula for calculating the break-even point. Fixed costs divided by price minus variable costs equals to break-even point in units. Some facts is that it is considered a margin of safety measure, and break-even analysis tells you at what level an investment must reach to recover your initial outlay. An example for crowdfunding is how much viewers do I need in order to get the money needed. Remember the conversion rate from viewers to donors is 3%, and the average donation is $25. For sales, calculate the number of units you need to gather your goal.
We identified 3 different types of rewards for donor: pre-order, services, and swag.
Okay.
The first type is pre-orders. This is by far the most popular type of reward. This involves selling pre-orders of the product to the ones who contributed, and this way is kind of like an exciting way for the bakers to feel the excitement of contributing to this product.
The second type is services. If startups don't have the resources for making pre-orders, they can have, for example, a home-cooked meal for bakers.
3. Recognition or swag. This category offers backers personal recognition for their support, as well as companies' merchandise, which could be hoodies, t-shirts, or even pens.